Hey everybody, happy Thursday, February 26th. It's about 11:40 in the morning on the West Coast, and it's time for another market update. Real quick, before I get into it, there has been some more tariff drama. I didn't want to take up space on this about more tariff drama because we really don't know which way that's going to go, but that's definitely been affecting the markets over the last week, so we'll have to keep an eye on what happens there after the Supreme Court case. So first thing, going back to last Friday, we got December's PCE inflation report, and this came in hotter than expected, which is not good. Like we've talked about over and over again, the lower inflation goes, the more likely it is the Fed will cut rates. So take a look. It was up 0.4% month over month on both the headline and the core. That was about zero point 0.1 hotter than expected. Both were supposed to be up about 0.3. It's at 2.9 for the headline year over year and 3% for the core. Again, both were up slightly above estimates by 0.1. So they're both. This wasn't good news. However, the markets did take this in stride because again, it was December, so it was pretty dated. We're again end of February now, so this is a snapshot of a few months back. A lot has happened in the meantime. They've seen some other reports. So since this report had been delayed, it didn't move the markets as much. However, again, any inflation numbers that look higher, we're not really going to like. Next thing we got. So we got a look at the Q4, the quarter four for United States GDP. So it's the first look. I think they do three different looks at this because it takes three different times for them to get it correct, I guess, like most things the government does. But it was up only 1.4%. That's the estimate. And the estimate was supposed to, or it came in at 1.4. The estimate was supposed to be up 2.8%. So almost half, or basically half of that estimate. The government shutdown did have a big part in that. You add in that part, it sounds like it would be about 2.5, but even then, it would have missed estimates. So, not necessarily the strongest look at our economy. Again, anything that makes our economy look weaker is probably going to be better for mortgage rates because economy looks weak, then the Fed's more likely to cut rates to stimulate the economy. Next thing, December appreciation. So we got appreciation for the month of December, and it showed that it's on the rise again. So lower rates at the end of the year definitely helped. So this is the Case Shiller Home Price Index. So this is does not, or it includes everything. So it includes cash and jumbo deals, and this came in at up 0.4% seasonally adjusted month over month. Year over year, up at 1.3%. Again, climbing, and with rates continuing to come down, which we'll get to in a little bit, that should bode well for current homeowners that to get that appreciation. Again, just basic supply and demand. If there's not enough supply out there, and there's a lot more demand, if rates come down, then that's going to drive prices up, and that's what would drive these numbers up. So again, not necessarily good news for someone that wants to see prices come down, but good news for current homeowners to see that on the rise again. Next things, we got November and December new home sales. So I want to point out November was up 15%, which is a huge number because when these came out, they released them both at once. And like CNBC and stuff like that made a big deal about December being down negative 1.7% month over month. But again, that was down negative 1.7% month over month from November when it was up 15%. So still, December was actually a really good month compared to previous months. So very good for new home sales. Again, that kind of bodes well for going forward. That shows that at the end of the year, they were able to get more people under contract on these new homes with lower rates. Probably were able to add some incentives in there for them. So again, just goes to show that as rates start to come down, there's going to be a little bit more demand, and you'll see pending home sales and new home sales and things like that start to kick up appreciation. So good for builders. Initial jobless claims came out today. 212,000 new claims. 210 was the estimate. So again, really low numbers. But we have to keep an eye on that because again, inflation and jobs are the two most important things the Fed is currently watching. So where does that leave us? So that leaves us at 6%. Twice this week, it was down at 5.99%, according to this lender survey. So the average 30-year conventional, according to all the lenders across the country, they fill out the survey for very good borrowers. It's right around 6%. So last week we were at 6.05%. Right at that boundary again, coming if we get break below 6 and make a nice little headway underneath 6 to 5.75 or whatever it may be, that's really going to stimulate the economy. Obviously it's good for payments, but it's also going to be good for people's appreciation because like we just talked about, that's going to create more demand in the market, good for the industry, things like that. So good to see we finally are at that boundary, and let's see if we can get below it. So that's going to be the battle. Do rates get below 6 and stay there, or do rates go above 6 And we keep running into that that wall every time here at 6%. So the thing that's going to lead us there is probably we got the BLS. The BLS jobs report is coming out next week. Again, these tend to come out higher than expected. If that happens, that's probably going to force rates up. But every time these numbers come out, they end up chopping them down lower later on when they get the real numbers. So we'll have to keep an eye on that. That's next Friday, I believe. A week from then, we got about a week from then, we got CPI, another look at inflation. And a week after that would be the conclusion of the Fed's most recent meeting on March 18th. That's when they'll make their next announcement, whether they'll cut rates, raise rates, which they shouldn't do, or keep them where at. Which right now the odds favor them keeping them where they're at. But again, maybe that jobs report comes out weaker than expected. Unemployment goes up. Maybe that inflation number looks really good, and maybe we get a cut in March. So good to see we're at 6%. Now let's hope that we get below that. If anybody needs anything at all, don't hesitate to reach out. Have a great week, everybody.